Good afternoon, everyone. This is Bob Dole again from Solution Driven Wealth. And today is March the 18th, 2021. Today, we're going to talk a little bit about expected changes in trust and estate tax policy from the new Biden and Harris administration, and how that will impact our client situations, and how we really have to have an ongoing and active dialogue with our clients if their hope and dream is to pass on the largest legacy they can to their children and to their grandchildren. So what we feel is really a fundamental and really a fundamental shift in estate tax policy. And what I mean by that is right now, currently, you can shelter about $22 million on a federal basis from estate taxes. The new administration wants to bring back those thresholds closer to about $3.5 million per person, or probably about $7 million. Again, nothing is firm and set in place right now, and this will be debated over the next coming months, but we need to be prepared as your advisor and to give you the proper strategic advice on setting up your estate plan for you and your family. As we've already seen last year, the Secure Act changed some of the fundamental provisions as it relates to IRA planning. And what I mean by that is that last year, we talked in the beginning of the year before coronavirus hit about the change in retirement age, meaning RMDs, required minimum distributions, not taking place until a mandatory age now of 72. However, the big change meant that for those inheriting monies who are not spouses, meaning your kids or grandkids, they have to exhaust those accounts within 10 years, not over their life expectancy. So, for example, for a client owning $1 million or having $1 million in their IRA account, growing at about 6%, as this example will show you, in the bar chart showing here, we'll see that $1 million, 40 years out, what was left to the heirs under the parameters of about a 6% rate of return. We can see that after 40 years, about $1.5 million was gobbled up in taxes. So a huge impact really to the heirs inheriting this IRA account. Again, can no longer stretch these out over your life expectancy if you're a non-spouse, have to exhaust them in 10 years. Many clients ask us, Bob, do I have to exhaust it within 10 years on a proportional basis? You do not. You can wait strategically, and we talk to clients about that all the time, about when you might retire and when you might want to take some of that money sooner. Now, based on our prior discussion about tax rates going up, it gets even more complicated because now we have to adjust for a change in tax policy on just regular tax rates. So again, active, ongoing dialogue with you and your tax professional is of paramount importance to make sure that we maximize the amount that you pass on to your heirs. Under the old rules, it was typically done, and I'll use myself as the example. If I owned an IRA and it had $1 million in it, I would pass it on to my wife, Donna, and then Donna, when Donna passed away, she would pass it on to our 4 kids in what's called an inherited IRA, and then the kids would take that out over their life expectancy. That was the old best practice that worked great for many years, but it's not the way it works today. My kids will not realize the maximum achievable from that type of scenario. So what we want to talk about now is more family tax rate planning, which is something we talked about at the early part of 2020. What we might want to consider doing is taking some of my IRA and yes, paying it to my wife, Donna, but also at the same time, paying some of the asset to my children. Why would I do that? I would do that because it would stretch out to the extent possible the gains on that account or the taxes on that account, meaning a lower bracket. So when I look at the totality of my asset and trying to pass that on to my heirs in the biggest way possible, I might want to consider this strategy here shown as the new spousal rollover trap and doing this in a better way than I used to. As it relates to both income and estate tax planning, it's really important that we stay in touch with you this year, more so than ever. Tax rates are changing, and we need to be proactive in our planning.